Yeah. Okay.
Hi folks, welcome to the live stream. We're in pre-show mode just for a few moments, enjoying the chat. Even if not everybody likes the music, sorry folks, but you you don't pay much for it, so just roll with it. At least it shows that we're alive and kicking and here. Great to have so many on, and nice to see some new names as well as some of the old faithfuls. So good to see everybody here. It's I'm going to put this one up. This was quite funny. We were talking about Phil Lowe. Somebody said, Phil Lowe's a fool? And I said, well, he's a well-paid fool. And that got into a very interesting discussion about how much public servants are paid. The RBA guys are right at the top of the list of how much they're paid. Cookie, you made a good point. Hi there to you. You should invent the mute button. If you don't like the music, turn it off. I agree. Exactly right. Somebody else made the point that I really am not a composer and a musician. Well, I do a bit on the side, but I don't really spend a lot of time doing it. So look, at least it's better than some of the stuff I heard on YouTube. So I'm just going to roll with it. As Otto says, I wouldn't say Lowe's a fool. More than our public institutions in the RBA are captured by vested interests. Ah, yes, captured indeed. And if you want to know more about that, you should listen to my show today, which I put up with my friend George, where we went into the rabbit hole talking about the Reserve Bank. Cookie Boy says, in the shower dancing to your epic music. The mind boggles, Cookie, the mind boggles. Very good. Hi Zach, good to see you there, and good to see so many others on as well. I'm not going to go back and say hi to everybody who's been on already, but good to see everybody on. Okay, we're ready to go. I've got Chris on standby, so I'm going to take the pre-show monocle off. I'm going to run the intro, and then when I come back, we'll get going properly. See you in a second. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our live stream event today on the 13th of April 2021. Glad to have you on again, and big show tonight. Got Chris Bates ready to rock and roll. Just before I bring him in, I just want to go through my normal reminders, and that is that we actually don't provide financial advice on this channel. This is just a general conversation. We don't know your specifics. Do play nice in the chat room, please. We do moderate the stream, no racial slurs. This is as at the 14th of April, or sorry, should they? 13th of April. I'm ahead of myself. Anyway, April 2021. Use @WalkTheWorld to get my attention if you want to participate in the chat and ask a question, or if you want to use Super Chat either to get your question to the top of the queue, or indeed just make a contribution to the running of the show. All greatly appreciated. But now, without further ado, let me push a few buttons and bring Chris Bates in. Chris, hello, are you there? Hello.
Hey Martin, I'm here.
Yeah. I can hear you. Can you hear me?
I can hear you, yes.
Yeah, jolly
How
good.
How are you?
Yeah, very good. All working.
Yeah, that's good. I was a bit scared there for a second.
No, it's all good. And we were just saying off air, this market, it really is doing weird things, isn't it? And it's moving quite fast. I think we chatted about 6 weeks ago. And, the very interesting observation is that things have continued to fire up in certain areas. So we're going to try and explore some of those. Also, I think try and get some of the gradation in there, because not everything's moving at the same rate. And perhaps pose a few questions that people should think about at this time in the cycle. But what's your sort of general take on what's been going on?
I mean, I can't believe the last 2 months, really. I think there's always a bit of a pent-up demand that kind of comes over Christmas, and, there was a lot of positivity and there was no real negative things that happened. And so coming into the new year, we were, seeing lots of pre-approvals and still very low, listings across the country and in certain pockets in particular. And, we expected prices to rise, but don't think anyone really expected some of the results that we've seen over the last probably 6 to 8 weeks since the last chat, Martin. There's just been enormous FOMO really and desperation on a very small number of properties, and new price levels really getting set in the suburb where that sold for that, so this must be worth this. And it's a very dangerous sort of buying mindset that happens once people see that sales and they start to believe everything's worth something because there's been a couple of sales. And so I think it's a bit too early to say whether there's going to be a floor to these prices. I think there's been quite a few more listings I think in the last couple of weeks since Easter, and so I'm really interested to see sort of how this maybe potentially a little bit more listings if they still have the same competition prior to Easter. So the next 2 months will be really interesting to see if it just keeps on kicking on, or whether some of those sales look back and go, well, actually someone potentially paid a lot of money and it's jumped ahead of the market a bit.
Well, it's very interesting, and I think you make a fascinating point about the low volumes. We'll come on to that because, of course, some of the metrics that are actually being quoted are based on extremely low volumes at the moment. Yeah. I just want to acknowledge a couple of things. AI, thank you very much for the power bills. Really appreciate that. My power bill is horrible, and I just had a suggestion from the power people that they're going to take me onto a new plan which is going to be 6% harder than the one I paid last year. So I've got to do some searching around, and appreciate that. And also Jason M, thank you very much for that contribution too. Really appreciate it. Now, in terms of what we're talking about, these low volumes, I think it's worth just highlighting, Chris, that a lot of the sales are at the sort of the upper end of the market, right? Particularly standalone houses. So in a way, that's been distorting some of the metrics.
Yeah, I mean, exactly right. The housing market's where there's competition and there's lots of buyers and very few sellers, and apartment market's pretty well publicised is struggling because of the investors, the COVID impact of people wanting more space, the building issues, etc. So we don't probably need to go into too much detail about that, but you're seeing a high portion of houses, and then potentially more the areas that are, say, on the higher end, so the inner ring and the sort of upper end premium. And so that all these sort of things distort the median figures. But you and I both joked, Martin, we don't really care about those numbers. What we want to see is actual case studies and multiple case studies where you can see, that property sold at 2016 for this price and now it's sold for this price, and you can see what renovation they've done and, and multiple. That's when you really understand how much the market's really moved or moving.
Yeah, comparables, right? That's the critical thing. Comparables, right? In other words, property A versus property B, how similar are they? Are they in similar locations, similar characteristics, etc., etc.? And look, I don't think the hedonics does it very well, right? You've really got to get really granular. I was doing some work the other day on a inner city postcode where prices have only gone up about 1.5% over the last little while, right? And it's actually houses rather than apartments. But when you look closely, you got to say, is it on the main road? Is it not on the main road? Right? How far is it from the local station? How far is it from the local amenities, etc., right? And then you find other properties in the similar location, and then you can begin to draw some conclusions about what's really going on. But if you just look at the overall index for that particular area, you get nothing like the right answer.
Yeah, and it's a lot of work. We get clients, even just today, clients, what do you think of this, Chris? How should we make an offer? And I'm like, well, to do that research and due diligence to figure out what it's worth is hours and hours to really kind of understand what's selling, what's sold, what else is on the market, the vendor's motivation. It's a lot of work to actually, and a lot of detail that you're just not going to find out unless you've got inside knowledge from a real estate agent. So, it's really hard for buyers at the moment because the market is moving on them, and unless they're super desperate and go and pay 20% over the guide prior to auction, then it will go to auction. And a lot of people don't want to be paying 20% over the guide. So, but someone is. And so it's a really tough one to value a property. And the problem is in some suburbs, similar houses that are not the same quality, one might be a busy road or south facing or privacy issues or building issues, are selling for similar prices. And that's always a worry when I see that, is because you think, well, that's not getting discounted for the things that make it, holding it back really, or will hold it back long term. And so it shows that there's a lot of desperation in the market when that happens. I don't think it's happening everywhere. I think, buyers are definitely more picky than they were, say, in the previous boom. And I think, what people know, that the house is, a lot of COVID, had to spend a lot of time at home, the kids, it's working from, study at home. I think a lot of people thought, the house needs to be in a better location. We're not just going to accept anything. So I do think the lower end, poorer quality properties will still struggle because buyers will still be a little bit more picky than they have been in the past.
Yeah, I think that's right. And I'm certainly seeing Western Sydney areas in particular are still wobbling. Of course, we'll come on to apartments because apartments is a whole other story. Not a very popular story to tell because it's not the same positivity as standalone houses. Just a couple of quick comments. Tony, thank you very much for your contribution. Really appreciate that. And Cookie Boy asked you, Chris, thoughts on underquoting. What do you think? Is it happening? What are the solutions? Should we ban price guides? Discuss.
Look, you can really attack the real estate agent and say, look, you're underquoting it. But the market is moving on the real estate agent. So when they did that pricing and they originally looked at it, they always underquote. Like, it's just, everyone knows that that's the case. They will find comparables that are potentially not the best comparables, that are cheaper. So they can get a lower price guide because they know if there's a lower price guide, it's going to create more buyers. You don't want to put a high price guide on it and then people think I'm not got a chance, especially if everyone puts a 10% premium on the price guide. If everyone thinks that everyone else does that. So a real estate agent is damned if they do, damned if they don't. If they don't do it, they're going to lose a lot of buyers who think that it's going to go for 10% more than their price guide if they price it correctly. So it is an industry problem. At the moment, it's potentially even worse because the comparables they're using and how much the market's moved, the real estate agent, could say, well, when I listed this, I did think it would be in that 0 to 10% above that, but now it's selling for 20%, even 30%. We've seen some even more. I saw one a couple of weeks ago, it was 40%. So it's actually more, it's like 60%. Sold for 3.2 and it was on for 2. So it's tough. When those big jumps over the price guide, I do think those agents, should be watched a little bit. And because it's obviously something's happened there that's not right. If it's 10, 20% over, yeah, okay. But if it's 30, 40, I don't know. It's hard to really, what's the right strategy? Do you put on what the reserve's going to be, what the price guide's going to be? It's a really tough one to answer.
Yeah, in Queensland, of course, they have less guidance. Basically, it's a bit even more foggy. The question is that fogginess good? The problem is, of course, where do you get good data from to be able to actually make good analysis? Because either you need an estate agent that you can trust to give you, chapter and verse and the right answer, or you have to try and do it independently. And a lot of people get caught because, unfortunately, they're spun a yarn rather than actually be given really good information.
You've got to be going to the auctions, to be honest, because that's give you that real time. Staying close to agents, other agents in the area that, you might not have sold that property, but can hear what it actually sold for. Obviously, you've got the New South Wales registry and you can sort of look at past sales, but there's a lag on that. So for me, it's on the ground, relationships with agents and going to actual auctions and seeing how many buyers are out there, what are things actually selling for. And so when you're new to a market, especially in booms, when people get pushed out of a suburb, and they're frustrated and they've got time pressure and the market's moving on them. And so they're fearful that they're going to keep running on them. So they have to leave that suburb and they go to a new suburb, but they don't really know as well. Maybe it's similar to where they are, but that's got, nuances to it, different roads that you don't want to be on, which you don't know about. And so you haven't really seen many sales in that suburb because you were looking in a different suburb. They're the real dangerous buyers. And who are new to the market and then just overpay for the poor properties. And that's what I'm definitely seeing, around where you think, hang on a sec, how is that poor road selling for that price? If that's worth that, what's the good road worth? But, there's a lot of the better roads aren't hitting the market.
Yes, absolutely right. Now, one of the things I want to talk about with you, Chris, is this fear of missing out, right? Is FOMO still there? And there's a lot of it written about in the press, right? The question is it real? Is it not real? And maybe we should sort of go around each of the sort of the main segments in the market. Let's start with first home buyers, right? I'm certainly seeing many saying, oh, I need to try and put a bigger deposit together. And then, how do you do that, right? And there's lots of questions about how you build a deposit. one of the things I am seeing is a lot of help from the bank of mum and dad. We might touch on that in a second. But FOMO, what's the story?
Absolutely. I mean, first home buyers, and also I think people who have bought a apartment for their first home, and they will say they were single and now they're in a couple. For me, they're like first home buyers anyway. They've just got a bit more cash, but they've potentially missed out or they've seen the last boom. So they might have bought an apartment in 2014 and that really ran on them, or they didn't actually buy in that boom because the prices run on them. So there's also, or they were just watching the market and they saw that happen and they got worried that they'd never be able to afford a house. So, that's still quite fresh in a lot of people's minds. And so when they're seeing the market move fast and they see rates low and then the media gets behind it, absolutely it creates all this fear that, especially if they're getting to that family formation phase and, kids are on the way or they've got young kids, absolutely they don't want to be priced out and then have to move city and move away from family, etc. Bank of mum and dad, absolutely. We've seen it because their properties are potentially worth more because they're confident about the property market, and they're willing to give a little bit to their kids. And most, if depending on each situation, but I'd say most, probably more than 50% are getting help from their parents, and it's quite a lot of money that they're getting help with.
Let me just come in there and share a bit of data. This is actually my data, right? So this is the bank of mum and dad. So it's about 60% of those actually who are buying at the moment, first homeowners, are actually using the bank of mum and dad. You can see how that massive dip happened and then it's come back very strongly. So that's the first data point, which I think is a very significant one. The second data point is the average amount is now, 90,000 basically. That's the average amount that's being handed across, whether it's a loan or whether it's actually just paid down to the kids to allow them to buy. And interestingly, quite a few of them are also adding into that the 20k from the superannuation drawdowns either side of June, thanks to the the COVID arrangements, and also adding in anything they can get by way of grants from the government, either state or federal, right? And you can basically construct quite a big deposit, which means you can then go buy. And the other interesting data point, which I'll just share with you, is this one, which is that the Bank of Mum and Dad is in the top 10 lenders. This is stacked by the total estimated value, right? So about 33 billion are actually sitting there in the Bank of Mum and Dad, which puts it ahead of the Bank of Queensland, HSBC, AMP, Members Equity, right? Just behind Suncorp Metway and Bendigo Adelaide Bank. I mean, this is a significant factor which is definitely impacted, particularly, I'd make the point, Chris, in Sydney and Melbourne, where, of course, the prices are very extended.
Yeah, I mean, parents want to help their kids, especially if they want them to stay close, say there's grandkids and things like that. So I'm glad your stats do go along with what I was saying. I didn't have the data to back up what I see on the ground, but and I'd also see the confidence, how it kind of dropped off and then it picked up. Parents do want to give it when they're confident that they're going to get it back as well, right? So that makes sense there. I mean, the first-time buyers are really struggling. It's, there is sort of limits on how much they can borrow and how much due to their savings. And savings usually the thing holding them back. And so a lot of them are going back and saying, look, mum and dad, look, if we had another 30,000, we could buy, spend another 200,000, because every 15,000 that they've got basically improves their purchase price 100,000. And so we're seeing that, yes, they're going to find more money. Just we're saying, look, if you want to increase your pre-approval, you need more money. And a lot of pre-approvals are increasing what they what they want to spend basically. So they usually thought 1.2 and now they're going up to 1.6 because A, the market's moved on them, and B, then they're worried that it's going to just keep running on them. So it's very interesting. Interesting thing for us as a business, we do a lot of education on what's a good property, what's not a good property, is it a good decision for them long term, and don't buy that and potentially buy this. And so our clients are a little bit more educated than say most brokers would just say, here's the loan, go spend it on whatever you want. And so we've got the most pre-approval than we ever have. And we're actually not doing that many purchases, which is, March wasn't this sort of crazy month where lots of people bought because they were all getting blown out by all these desperate buyers. And so, it's really tough for first-time buyers, especially the ones that wanted to buy last year and life took over. They just weren't ready or they were a bit hesitant making offers. they didn't get the deal done late last year. Christmas happened, and then prices have moved, 10 to 20% in some areas, and their whole plan's gone to pieces. They just cannot go there. And so I really feel for those buyers that just couldn't make it happen last year for some reasons outside their fault.
And it's worth just reflecting it takes on average 10 years now to save for that deposit, right? Looking at the data compared with 6 years a few years ago. And the other point there is that you get the deposit, and then you sort of, as you say, find that the market's moving away from you, and you then start to panic. And so I'm seeing a lot of people still panicking, saying, "Oh yeah, I'll never get in the market. I'll never get in the market. I've got to buy now." And that's when you often go and then buy stuff that you shouldn't buy, right? The second class, the slightly less expensive property in the in the less good areas. Unfortunately, those often remain laggards, all the way. So you make the wrong decision on the way in, and then you get stuck with it.
Yeah, and that's definitely happening. And we're having to stop a few clients, like literally this week, even today, where they're feeling a lot of pain. The pain from over Christmas, but then the pain is they've been blown out at auction multiple weeks in a row now, and they're either looking at alternatives. I should buy an investment property somewhere, or should I, buy this apartment, and they're just going away from completely what was a good decision because they were so close. They just don't want to go through the pain anymore. And the interesting thing is, because interest rates are low and they're likely to stay low, and the fixed rates where they are, that's interesting. Fixed rates are moving a bit, but the mentality shifted on the appetite to take on the debt. And so, someone taking $1 million mortgage, say, when rates were 4%, we're probably paying $5.5 grand a month. But then that will now, for that same amount per month, they could probably borrow 1.4 million. Assuming rates were say 2% on a fixed rate. So, a lot of people are willing to take on that debt because they're confident that rates are going to likely stay low, and they know that that'll get them a house, etc. So, that's where you say about affordability. Well, if rates do stay low, and people are willing to take that bet, then you can see why people are willing to spend a lot more money.
Yeah, good point. And I just want to make the other point there. The debt to income ratio is very interesting, right? I don't know whether you're seeing this, but I'm seeing the debt to income ratio going up quite a lot. So at one stage it was sitting at sort of 6 to 7. We're now seeing it 7, 8, 9. I've seen one this week at 10.
Are these new buyers?
Yes.
Yeah, it's very tough to get more than sort of 8. 7 is starting to get looked on from the banks, which is just communication from different banks where they don't really want to see 7 times more. It's got to be super strong and lots of good history. 6 is very common. 6 to 7 is what a lot of people are spending. To get more than 7, 8, you need to be pretty crafty. You need to be using lots of non-banks and playing your loans around and be pretty strategic. I don't think it happens as much as it was. But going back to 2014, that was every bank. You could get 10, even more times, especially if you're looking to buy investments rather than homes. You could borrow a lot more money. And so I do think things are wound back from there, but people are maximizing. They're not willing to say borrow at 3 or 4 times their salary. They're saying, well, let's borrow at 5 or 6 times because rates are low. And so what you're doing is you're creating a lot more, capital in the market. Yeah,
and that 10 times one was a non-bank. They deliberately went to the non-bank because they were turned down by the majors and the regionals. So they went to a non-bank, and they're paying about a 1% higher interest rate.
Oh yeah, easy. I mean, it's some of the non-banks have got pretty competitive products, and so you can go there if it's potentially. We don't really like using non-banks. We just worry about their funding line and getting stuck there and becoming a mortgage prisoner, which you spoke a lot about through the other downturn in 2018. Martin, where people can get stuck on higher rates and those rates can jump on them. So we're not a massive fan of non-banks unless we have to go there, and we very rarely do.
Well, what about upgraders then? So the people who are looking to move maybe they're looking to improve rather than move.
Yeah, and this is an interesting point, right? Like if you go and spend, got $1 million property and you spend $500,000 on it, well, you've increased and you borrowed that money. Well, that's going into the property market and it's increasing the median. And so the renovation boom is absolutely going to flow through on prices. People weren't going on overseas holidays. They're spending a lot of time around the house. All the data sort of points to a renovation boom. So the other thing why they're renovating is there's no other alternative, like the Tina effect, where they look at the other prices, the properties they want, and they've run on them, and they can't even see them online anyway because they're just very low listings. And so they say, well, yeah, even if we do want to upgrade, I'm not going to sell my property because it could take me 6 months, it could take me 12 months, and the market could move on me, and then we might have to. A lot of people, especially the downsizer market, are worried that you could be homeless or we're going to have to rent again, haven't rented for 20 or 30 years. And so a lot of upgraders just want to sit on their hands until they can really see lots of properties on the market. So this Mexican standoff sort of kind of dominates, and that's where you're getting the renovation boomers. It's all too difficult. Stamp duty is 5%, selling costs. I don't really want to take on that extra debt plus pay all those costs, even if rates are low. Let's just do a renovation.
Yes. Now let's turn the other table then, the downsizers, right? I do a lot of work with people who've got a property, and quite often the mortgage is sort of quite well repaid, if not completely repaid, but it's getting to the point where they're thinking, I've got this equity, maybe I should think about moving into something smaller. And then they start looking at it and then realize that there are a whole bunch of barriers. It's not as straightforward. It gets really, really, really complicated, and the risks that they're actually coming up with are actually quite significant quite often.
Yeah, a lot of downsizers particularly want to stay in the suburb that they're in, because they've got friends and networks and they're comfortable there, and they don't want to swap suburbs. And so they look at cheaper houses or smaller houses, and they've got a lot of the demand from first home buyers. So they're going up a lot. And so, they could cash in, but they're not going to cash in as much. So a lot of the bigger, older apartments, they just don't exist, and they're very competitive. And so they look at the sort of trends, whether they should do it, and they go, well, there's not actually much money in the pot after they do it. So downsize is a really sort of tough one to sort of navigate right now, where they're going to, there's not actually another property I want to buy. And also, is it financially better just to hold my house? Should I downsize in 3 years' time when house prices are moving? If I've got a bigger asset, it's financially better just to stay here and ride out the boom. And so that also happens.
Yeah, and there's some interesting debate as to whether the government's going to try and do something to stimulate people to move into smaller places, right? I mean, there's been a talk about it quite recently, and there's probably going to be more talk ahead. I guess the other point is that the stamp duty stuff gets quite interesting as well, right? Particularly if you are transacting. And again, some of the downsizers I've spoken with basically is thinking, hang on, the transaction costs even to buy a relatively smaller place is still quite extended, and then they do the math and think, hang on, I'll stay put.
Yeah, exactly. And the stamp duty changes, who knows, it should be coming out soon, what may or may not happen there. And do we really need this other rocket added onto the market right now? Probably not, but they're pretty keen on it. So I'm very watching that. Also, the responsible lending changes, what happens there. Yep. There's a lot of push to access super for first-time deposits. Not a good time, not a good thing. So, it's interesting, all these other things that could add more demand to the market.
Well, it's very interesting, of course. All of those are potentially further boosters to a market that's already quite hot and probably getting hotter, at least in the short term. Although, of course, on the other hand, you've got JobKeeper and Seeker coming off, and some more concerns now about the lockdown and how long it's going to go for, and whether international borders will open next year, let alone this year. So, there is, again, some uncertainties. But I guess the uncertainties I'm interested in now, Chris, is property investors, right? Again, I've done quite a lot of work with a bunch of property investors, both who've held portfolios for some time, others looking to get in, others who've never done the calculation as to what the returns really are. And when you actually sit down with them and do the net returns, they fall off their chair, realizing how much they're losing. Property investing is pretty tough at the minute.
Property investors, most don't do a good job. We've seen thousands and thousands of people been solely talking about property for the last 9 years, and we very rarely see the property investors who have done it really well. The problem is that a lot of them have gone where other investors have, and so you get this sort of group of them around, say, apartments or new house and duplexes in Southeast Queensland, or their houses, 30, 40K because they're cheap, and they've been sold the dream by some sort of property expert. So a lot of investors haven't really done it well, and they've also been smashed in the last year because of the rental vacancies, and there've been apartments, etc. So if they get any sniff about getting out, and they can write off this, say, massive demand in first home buyers, then they're potentially going to get out. Even today, a client had a townhouse in Brisbane. He's like, I know it's not a great investment. I've learned, I'm much more educated than I was when I bought that. And, I would like to get rid of it. And when you got that type of property, you don't just want to rush and just do a fire sale and sell it at any point in time. And so we're just like, well, let's just have a quick look on real estate and see what's actually selling. And we were shocked that, this townhouse has actually started to rise quite a lot in the last 3 months. And that shows the desperation in the Brisbane market. And so him as an investor, he's saying, well, yeah, actually now's a good time to potentially try to take advantage of that, because when new prices go up, say in townhouses in Brisbane, other developers, even small-time developers, be saying, well, let's do that for townhouse development now because we can sell them for $750 each, and so more supply will come. The same thing as apartments. As soon as apartment prices start going up, developers build more. And so if you've got a poor asset because of a supply issue or a demand issue, this may be a good option just to sort of, get out and then reuse that capacity, reuse that equity to pay off your home loan or to reborrow and buy actually quality assets. So, I do think that's happening.
Absolutely. And again, my conversation with a number of investors are showing a greater propensity to think about putting on the market and getting shot of it, right? Because when you do the maths, particularly with low interest rates, you don't get as much benefit from the negative gearing and those sorts of things, right? Which is something else they hadn't thought about too.
And it was painful for them in 2020 because, they used a lot of their cash flow if they didn't have a tenant or they've got maintenance issues and, they might have had job issues, etc. And so that was a stressful thing for them. And so, if they could get that stress out of their life, they would they would do that at any chance. And so I think that's a big part of it as well.
And I just want to underscore, as I sometimes do, Chris, is that the gross yield, which is the price versus the theoretical rental stream, is not a very good indicator of anything at all, right? What you need to do is to look at the net yield, which is the actual rents that you can achieve, and also includes the other costs that you're actually involved in looking at, right? And when you do the net, around 55 to 56% of property investors that I've got in my surveys at the moment are underwater.
Or in terms of just negative cash flow? Yeah. I mean, positive cash flow in property isn't really a thing that you should be looking to achieve. I mean, it sounds great. Like I have a property, it pays me to sort of own it. I always wonder what's really making it positive. What's giving it that high yield? It's either because people are willing to pay a lot of rent for it, but they're not wanting to buy it. I'm willing to pay $500 a week for this, but I'm only willing to buy it for $300,000. Well, why is that? Why aren't people really wanting to buy it? And so you start to figure out that's a high yield for a reason, or whether it's renting per rooms, or whether it's a granny flat out the back, and maybe that's not as sustainable as you think it is. Maybe when that tenant leaves, you can't re-rent it. And so I don't really get excited by a high yield on a residential property. I always start to think, well, what's the cost of that? What's the opportunity cost that's giving it that high yield?
Yeah, that's a very good point. And like I said, the trouble is people get fixated on the gross yields, which are meaningless numbers anyway. And it's interesting making some comparable net returns. A bit higher in Queensland, a bit higher over in the West at the moment, very low in Melbourne, and pretty low in Sydney overall as well. So
yield's also fully taxable. So if you get an extra $200 a week rent, you're like, $800 versus $600, you're like, that must be a much better property. Well, that's $10,000 a year, but after 40 or 50% of that going in tax, well, it's $5,000 a year. Well, that could be $1 million property. So if that property grows more than $5,000 a year, even though it's got a lower rent, and you pay capital gains tax, which is 25%. So maybe if it grows more than $7,000 or $8,000, it's a better property. So you've got to focus on the capital value, not the rent. Yield's fully taxable. It's a big mistake property investors make.
Right, now we're going to introduce everybody to Tina.
Yeah, I mean, that's really the no other alternative to, a lot of first-home buyers are experiencing it. There's no other alternative. They were in 2020 going to the regions, and that was great for affordability. It gave a whole access to more properties that, young families and couples in the city could look at because of the flexible work. And I think that's great, and hopefully it continues. Unfortunately, they've gone to the regions and they've pushed up all the prices in the areas that they really want to live. And these regional places have got a lot less properties. That's why they're small towns, right? And so all the sort of, the Central Coast, where you are, Martin, north of Wollongong, the Byrons, the Sunshine Coast, etc. A lot of these areas where people want to go have gone up 30, 40%. And so now they're back into the city and saying, look, let's just stay in the city. Let's just find something. that we can't go there, or we don't want to go there and have to commute. So, I mean, that's really playing out, unfortunately, at the moment.
Yes, and I think it's going to continue. I don't see that things are going to dramatically change, but it does make for very interesting decisions. But I thought I'd just share 3 articles, Chris, which are actually quite interesting, right? So this one, whoops, wrong button, sorry. Let's push this one first. There was an article in the Fin Review today saying the rush back to the cities has begun. So it's very interesting. I think you were talking about this actually last time you were on. So you were obviously prophetic. Not pathetic, but prophetic. And the fact is that maybe all that dashing to the regions is reversing.
Yeah, and we've seen definitely clients who would have looked at going to the regions. That we had lots trying to buy up Central Coast, near Martin, Blue Mountains, Bowral. And the return to work thing is a bit of a negotiation at the moment, speaking to clients. They want them back in the office. Employers are sort of holding their ground, and is it 2 days? Is it 3 days? And so I think that's, people aren't as confident as were in 2020 that the return to work is going to be, 2 days. It might be 4 days or 5 days. And so that was driving a lot of the move to the region, is that confidence.
Yes, and I also noticed that whereas 3 or 4 months ago I was having quite a few people in Melbourne in particular looking at Queensland and thinking, well, maybe Queensland is a good place to go to. The storms and things they had up there and the price rises has rather sort of taken the guilt off that gingerbread, and so they're sort of thinking maybe Melbourne's not quite so bad now. So it does show you how fickle this can all be. There was another article that I think was quite interesting, which is that UBS came out today and said that JobKeeper's demise could double the numbers of properties for sale. That's based on some surveys that they are doing. And I guess that comes to the question of, stock ahead, because I'm noticing, I don't know whether you're seeing it, Chris, but I'm noticing an increase in listings just started, and an increase in the number of people who are now saying, well, maybe they should think about putting their property on the market. So rather than seeing the listings numbers continue to drop through winter, we might actually see them begin to rise a bit sooner.
Yeah, I mean, let's say JobKeeper, you've lost your job, for example. You don't just go and sell straight away. You lean on all your other resources. They may have other savings, might have buffers, etc. So assume they don't, then they might have to sell. But where they're going to have problems are in certain areas where people have got high LVRs, low deposits. So they had low deposit home loans where they've maybe bought with a 90% a few years ago. So you get lots of new house and land packages areas, and potentially lots of young families who have only got one person working or younger in their careers, etc., have less buffers. So where are they? And so that's where I think you'll find the problems with the JobKeeper, or where investors are really struggling and they just get rid of their apartment. And so I think you'll find if there is going to be more listings, like doubling, it's going to be areas where JobKeeper is really going to play out. And that's the 2 areas. Is more listings coming? Yes. But if you're buying, you think, okay, more properties, more choice. Unfortunately, more listings, especially in an owner-occupier sort of driven market, means that more people are selling, and they're usually upgrading, or they're going to sell their apartment to buy a house or buy a bigger house. And so unfortunately, more listings also means more buyers a lot of the time with owner occupiers, because if they're selling that house, they need to go and buy another one. So you've got more competition, and the people selling today generally have more cash than the current market because they're getting today's prices. And so when someone does sell, like a client sold in Surrey a couple of weeks ago, they took the great sale price there and they bought in Randwick today just out of coincidence. And so, they had a lot more cash because they got a good sale price. And so, unfortunately, a lot of buyers are like, yep, great new listings, but it actually means more competition a lot of the time. And that's not potentially what you want to hear.
Well, I'll just put this one up. This is actually the mortgage stress chart for Sydney region, right? And the colour is quite interesting. So the reds and the darker colours are effectively where a lot of the stress is. That is very interesting because it maps very strongly onto 2 things. Firstly, it maps on to where the JobKeeper and job seeker issues are really very, very sharp, and also where I'm seeing more listings coming on. So there is definitely something going on to see that there's a lot of the stuff in the outer suburban ring is where a lot of this new listing is going to come onto. and those prices have not gone up much at all, in fact. So effectively, you could well see that some suburbs, there'll still be lots of demand and not a lot of property, but in some of those outer suburban areas where there's already high levels of stress and high issues to do with job keeper and job seeker, you're going to see more and more property on, and that's just going to put more downward pressure on prices there rather than upward.
Yeah, when you own property in areas where there's new housing estates, and you look over your fence or just drive down the road and there's farms and farms and farms. And every city's got this. The problem is when the government does an incentive to encourage people to build, like home builder, people are going to buy the new stuff, not the old stuff, and that yours is the old stuff. Even if it's a year old, it's old, and and it's nothing scarce around it. Your 300-400 square meter block is similar to what they're going to cut up. And there's so much land they can release. And so as soon as there's this sort of first home buyer boom and encouraging people, everyone wants new, not old. Everyone wants a new car, not a 2-year-old car, those sort of affordability belt. And all the incentives and what the builders offer encourages people just to go down that route. And so that sort of new housing estate where there's lots of other new housing estates and lots of people are settling at the same time, all in 2019, all with 90% loans. All young families, very similar demographic, and haven't got much other cash, and so you can see where you get these real sort of supply, problems, and that's where you're going to see it, and that's where you're going to have demand problems because there's not that fear there. Well, prices aren't rising, so why do we sit? There's lots of listings, and so you don't even get good prices out there. You actually get fire sales. If a fire sales happen, the whole value of the suburb starts to get revalued, and it's a real dangerous place to be playing.
And I'll just show you the Melbourne one because, again, similar ideas, You look around Werribee, look around the Dandenong, right? High growth corridors, high level stress, high levels of job keeper, job seeker, and now listings going up. So, yeah, you can begin to understand the dynamics that's creating it. And again, I think people should be really cautious if they're looking in those areas. And as you say, if you've got a 2, 3, 4-year-old property in those areas, you're going to be competing with the new stuff just down the road. Very hard to shift it.
Yeah, and they age really fast. You're buying a house for $200,000. You're not using the top material around town, are you? So you have to really worry. It looks new today, but you come back in 3 years' time and nothing's really holding up, right? And so you've got to be very careful. Client was going to buy a new thing today, and I was just like, it looks great. It's a new townhouse. I know you're frustrated that you keep missing out, but it's not hot right now, and it's in a good suburb. So why isn't everyone wanting it? And it won't look anywhere near as good as it does now in a couple of years. And so even in established areas, you've got to be super careful buying the new stuff because it still ages and it doesn't have that timeless factor.
Absolutely right. Now, here's just one I want to pick up from Chris King. Interested in your views on the changes to New South Wales stamp duty and its impact on Sydney property prices. Now, basically, there's going to be the option to go one way or the other way, right? So you can either pay up front or you can pay over time. The question is it going to have much impact or not? What do you think, Chris?
Absolute massive impact. And if you're thinking, I'll wait for 5% so I don't have to pay stamp duty, and so I make a saving, I think you'll be paying a lot more in the purchase price than 5% than you're saving on stamp duty. And you'll still have to pay stamp duty anyway through sort of an annual land tax. It's interesting, it won't be for every property. The state government will want to keep the top end of 20% of transactions and get the stamp duty up front on those. And so if someone might be buying something at $2 million, you're not going to get a stamp duty waiver, and so you can do land tax. Ultimately, the reason it'll pump prices up is it reduces the deposit someone needs. Instead of needing a 15% deposit to buy $1 million property, 150 grand, you now only need 100. And if you're at 70 grand, you go, wow, we can almost do this. We're almost there. So you start saving really hard. You ask families, and what seems so far away now actually seems doable. And it also, the media hype around it, and everyone will want to get involved because they're like, we don't need stamp duty. And so I think you'll find that. And also investors who've got, say, a little bit of capital, a little bit of equity, they're getting more equity now because prices on their assets are rising, and they're maybe done some money work on renovations. And so they don't need to pay the stamp duty on plus the deposit on an investment property. And so I think you'll find investors are back. And it's interesting, we are getting investors back. It's nothing like it was, in early mid 2014, 15 time. But investors are definitely coming back. And They don't want to go near the apartments, but they want to go near the houses, but the houses are running on them. And so they are going back to the older sort of quality apartments that are in the sort of, in Sydney, this is per se, where the house, once the people can't afford houses in the areas they want to be, they'll go back to like they were in 2016, 2017, moving back to apartments but only in the premium areas rather than the new builds.
Yeah, definitely looking in different areas for different types of property, no doubt about that. And I agree with you. I think that the stamp duty thing is a big deal. I also think that the other question, which I haven't seen answers for, is where are they going to close that gap, right? So if you suddenly stop receiving all this stamp duty from those transactions and you're getting a flow into the future, the councils are going to have a gap for a period of time, right? That's going to be another interesting one. How are they going to fill the gap? In other words, what other fees are they going to put up to cover the gap?
Yeah, that's true. They're hoping that transactions will rise 50%. And everyone thinks, well, 50% more property selling is a good thing, but every sale of a property is a debt-creating event. The person buying the property generally has more debt than the person selling the property. And so what you're doing is you're creating more debt. And the person who's selling the property, just mental accounting, if they're upgrading, they usually take all that money. They don't say, I'll put 200 grand into shares, 200 into my super, and I'll keep 400 for the property. They take the 800 and they put it into property. And so, because that's what's worked for them. And so what you'll find is that, by creating these transactions, you create these debt creating events, and that'll push up prices as well. So more transactions create more debt. So that's what they're thinking. But, especially in home buyer bills, home buyers selling, generally if they're upgrading, they take on more debt. And so more listings, more debt.
Yeah, and this is all fueled by debt, isn't it? The debt ratios are going up again, and the quantum of debt that's the banks are lending is also going up, even with those frantically paying down over there. The new ones are buying over here, so the net debt is going up. So this is a debt-fueled boom, which of course has to be repaid at some point. And I often say to people, just remember, the capital that you're borrowing still needs to be repaid. This isn't just about servicing the thing in the short term. You've got to pay it eventually, right?
Potentially, Martin, potentially not. You can always sell the property. And so, you think if I want to live in this, say, $2 million place, I've got to pay it off. Well, ultimately, you don't have to, you could slowly pay it off over 30 years. And in 10 years' time, you say, look, I'm going to sell it. And, you sell it, you pay it off via a sale. And so, I agree that you should be on, trying to pay off your debt. It's a good practice to build equity, to protect yourself, lots of reasons. But ultimately, it doesn't really matter if you pay it off, because you could always sell it, right? And it's a wealth creating sort of technique. And the other thing is low interest rates allows people to pay off their debt faster. And COVID allowed people to not spend anywhere near as much money as they did on lifestyle and holidays, etc. Right. And so a lot of people have got a lot of cash, and they're paying into their offset accounts, and they're smashing their mortgage, and so then that's giving them, more. Well, our mortgage was 800, and now it's say 650, and maybe we should do that upgrade now, or maybe we should buy that investment. And so low interest rates is also giving people that confidence to do other things because they're just feeling quite cash rich at the moment.
Yeah, well, this is another question I had beforehand, actually, from another Chris, who's basically said, look, I've got quite a lot of spare cash at the moment, right? Because, as you say, not spending on other things. I've got this mortgage. The rate is about 2%. Now, the question is the best thing to do to pay down fast and get that mortgage down, or should I do something else with the money?
Yes, you've got your cash, of course, and that's what's happened. The whole markets around the world are being driven by low rates because it's forcing people with cash to say, hang on a sec, I'm losing money. Even when you had, say, 5% interest rates, you lose 40% of that in tax, then you're getting 3% inflation. Let's say, I hope it's 3%, but it's not 3%, but let's just assume it's 3%. So your money in cash is never making money, right? And so but when higher cash rates, so say 6 or 7%, then you say, well, I don't really want to invest that money. I want to pay off my mortgage, especially if it's an owner-occupier where it's non-deductible. That guaranteed return is quite high. I've got to get 9 or 10% to beat paying off the mortgage. But when rates are 2%, you've got to say get a 3 or a 4% in your investment. And so it's very enticing for you to go into stock markets, into Bitcoin, into overseas markets, etc. And so that's what's pumping up asset prices is low rates. And ultimately, the government know that, hence why they're trying to, rates drive behaviour. And so investing is definitely one of those things. I do worry about that sort of using the offset account. Even a lot of financial planners, don't really understand how to access debt properly. And being a planner for a long time, it frustrates me that, if you've got, say, 100,000 in your offset account and you think, I've got enough for a buffer, I should invest the money. What you should be doing is thinking, well, what equity have I got in the property first? Have I got a little bit of equity? And then redraw that equity and invest that money, because then you get a tax deduction on that debt to offset the income on that investment. And it's a big sort of mistake that a lot of people make. You shouldn't use the money in the offset account because that's non-deductible debt. And then you'll have to pay interest at non-deductible rates versus investment rates, which are tax deductible. So, for that person there with sitting a lot of money in the offset account, should actually go and get an investment loan and invest that money rather than using the money in the offset.
Yeah, and the which side of the tax you are makes quite a big difference, doesn't it, in terms of the net position?
Yeah, exactly, and it just gives you a growing sort of investment debt, keeps reducing your home debt. When rates are 2%, you're like, well, it's not much difference. But if rates were, say, 4 or 5%, that difference could be 1 or 2%, and 1 or 2% return on your investment portfolio compounding over the longer term is a massive amount. So how you structure your debt with your investments is a huge impact on your net after-tax sort of return over the longer term.
Absolutely. Now, here's one to chew on, Chris. Zach says, do you think Australia will end up in negative interest rates? Give me your take first, and I might add to it.
It's an interesting one. I think if we start to see employment numbers go back and we start seeing inflation potentially rise, and do they keep dropping rates? I think but I've been proven wrong on interest rates so many times that I think it's a bit of a mug's game to start to play this, right? I was working in the UK back in 2008 when rates went to zero, and I was like, wow, I didn't even think this could happen. And they're still zero in the UK, 13 years later, right? And so if someone said to me they would be zero, I would have. And even just the last year, I thought rates were pretty low at 3%, and now we're getting, rates under 2%. I thought, how's that even possible? The bank's margin's 2%. And so the banks are, really undercutting what they're willing to make on you as a customer. It's interesting. That's why a lot of people are these amazing fixed rates the bank's willing to offer you, because they don't want to make money on you over the next 3 years. They want to make money on you on your variable rate, and then you not refinancing. And so be careful just falling for a good fixed rate at the moment. You've really got to make sure you're also getting a good variable rate. I'll just throw that in there as well. No,
that's very, very important. The old fixed rate trap, right?
Yeah, exactly.
Exactly right. And look, I'll add to this from two perspectives. This one I put up earlier, and this is actually the Fed chair, Jerome Powell, went on 60 Minutes in the US and was actually interviewed. I may do a show on this after, but it was interesting that he was talking about three things. One is he thinks the US recovery is really going to come quite strongly. He doesn't think inflation is going to be a problem at all, but he does think that rates probably will go up, but only very slowly, but no real sign of negative interest rates from the Fed, right? Now, whether that's true here or not, I think here the Reserve Bank is definitely saying we don't want to go into negative rate territory, and all the research from Europe and elsewhere shows that negative rates has no real impact in terms of trying to get the momentum in the economy that they want. In fact, all it does, it just forces the banks into a situation where they have to be fed lower funding from the central bank to be able to make their profits. So basically the central bank in the Eurozone is now paying for every loan that a bank makes. That's the net position. So there's a lot of reasons as to why negative rates won't necessarily work, but there's also an argument as to why negative rates might be required, and that is that if you think of what happened last time we had a big crash in the global financial crisis, rates would cut 4 or 5% to try and get the economy back to life again. We can't do that now without going to negative rates. If in fact the economy continues to drag its chain and doesn't really turn, and I think there's some questions as to how strong the economy really is, then they might look at it. But at the moment, I'm probably thinking it's unlikely rather than likely.
Yeah, I mean, ultimately, I think the rates are going to stay low, and what they, because they're ultimately. If we're going to a lot of debt, especially in our property market, and everyone's that will take a lot out of our consumption if rates rise, and if there's any fear of rates rising. And so the RBA are very concerned that they know that this housing boom's getting out of control, but they don't really want to stop it because they know that they want to stop it other ways, maybe by forcing APRA's hand, etc. Because they want people to be, still spending and thinking that rates and consumption to go up. So if they know if the rates are starting to rise on people with a lot of debt, and it's taken on a big mortgage, and that rates jump from 2 to say 3.5%, people will be freaking out. So the RBA does not want to increase rates. Obviously, the exchange rate problem as well, with the world not increasing and they can't re-increase and all those sort of things.
Yeah, exactly right. And in a way, we are just a shadow of what the Reserve Bank, of what the Fed does and what the Reserve Bank does. They will react to what the Fed is doing, I think. Let me just acknowledge Jason. Thank you very much. And appreciate that. Just bought Beam and Coke for the shout. Appreciate Martin's and his guest information. Incurring expenses to deliver us for free. Who's going to shout the next round? Hey, thank you very much. Well, I don't do this to make profit. I just put up there are costs involved, believe me, in running this show. So I appreciate that. Thank you very much, Jason. Now, there was some interesting conversations there. Otto makes the point that if you look carefully, no place has negative rates. And that is true in a way, because if you look up in Scandinavia, where there are some negative rate mortgages, although the interest rate's negative, you're paying fees. So the net position is still you're just paying differently.
Yeah.
So we'll see. And Cookie Boy says the rates will go up sooner than the RBA's 3-year forecast. External factors are going to be the critical driver. Whether in fact we will see that, who knows. And also another question here, do you think the macroprudential machine will be activated as quickly in Australia as in New Zealand? No, I don't. I think we're going to see APRA and the Reserve Bank saying nothing to see here, nothing to worry about. We don't even think the property's overvalued. We think the lending standards are fine. There's no reason why we would intervene unless the investment sector starts taking off dramatically, is my read. I don't know what you think, Chris.
I think they could do a few things. I think they want first home buyers into the market. And so the government 5% deposit scheme, I don't think it's going to be trying to do too much more of that. 90% plus loans, they've already highlighted that they don't want to see those increase. And so they could, if there is a dramatic increase on that, they could put more restrictions on the banks around those really low deposit home loans. Also, the high multiples to incomes, the debt to incomes that are over, say, 7 or 8 times. We saw banks that were going ahead with making DTI changes, and speaking to BDMs, we sort of get a bit of an insight of what they're thinking. And they were potentially going from a maximum of 6 times at certain LVRs to 8 times. It was a big change, and it opened up their bank to lots of other new customers who were having to go elsewhere. But they completely rewound that decision because I reckon they heard on the street and a bit of pressure with APRA that they don't want to see these high debt to income sort of loans. So I think the average debt to income is going to increase, but I don't think we're going to see this blowout with very high multiples. I think APRA is going to watch that very closely and be watching what the banks are doing. So I think they'll be doing things like that, tweaks around. They won't be sort of saying every property needs a 20% deposit, or investors can't be in the market, and because there's not many investors in the market anyway. So it's a tough one for them to manage.
And, the bottom line is this. They need the property market to go on giving, right? They need the debt machines to continue to run because that's all they've got.
Yeah, exactly. We feel wealthier if the house price has gone up, or if we do sell our property, we can spend 50 grand on a car, or we go on and so house prices are probably our only ticket to the game in Australia, and making people feel wealthier. And with rates low, they're hoping that they go out and spend that money, and that pumps up the economy. So that's the Australian the way we're built. It's not the greatest way because mortgages encourage you to take less risk, and so less innovation, less businesses take less risk because they've got the mortgages, and so hence why our economy and who we are as a country have probably got less innovation than other cultures. Because we are focused so heavily on putting people into mortgages, and you don't go and start a business if you've got a big mortgage over your head and things like that. So there's lots of social problems and things like that with higher prices. So, but that's the system we've built, and that system is unlikely to change because we haven't got an alternative system to move to. And it's so hard to make that transition. So,
absolutely.
I think that's what will continue to be the the game in Australia.
And it will be politically unpopular to change it, right? So, we are where we are, as it were, and it's just going to get a continuation. It's probably not an election winner to say, well, we need to take prices down. We're going to tighten lending. So I can't see the political will, but we'll see.
Also, the tax changes. I know they made some tax changes in the New Zealand around sort of capital gains tax and things like that. I think that the Labor didn't really go too successful at the last election with their big tax policies, and have they got the guts to sort of come back with banning negative gearing and lifting capital gains tax and franking credits, etc. I think they'll be a little bit more apprehensive going gung-ho and thinking they've got it in the bag. So I don't know whether they're going to have the confidence to do it, and the Libs are going to say, well, nothing to see here. So I don't think there's going to be any massive tax changes. Things like that could massively impact the property market, but I don't think, like you said, Martin, anyone's got the guts to go near it because they're so worried about blowing up the only thing that's sort of holding the country up.
Exactly right. Now, here was one that Cookie Boy said, are you seeing a drop or a rise in people going for fixed rates at the moment?
A rise. Just recently, CBA increased the fixed rates on their 4 and 5 years. What CBA... they are the biggest. What they're doing, I always like to watch. It's probably a good indication that, some of the other fixed rates are going to go up. So especially the 4-year fixed rate around 1.9% seems to be a pretty good deal out there. And so a lot of people are trying to get on hold of that one.
Yeah, I actually said about a month ago when the 5-year rates were really very, very low, that was probably going to be the real sweet spot in terms of the fixed rates for that period. They've now gone and they're, if they're there, they're higher. But there's still quite a few people who like the certainty of what they're paying for that fixed duration. And with all the talk of rates potentially going up sooner, there is, I think, I see in my surveys, a bit of intention to go fixed. Although, as you mentioned earlier on, got to be a little bit careful with locking yourself in at the right point, right?
Yeah, the break costs are usually priced on what the other alternative fixed rates are at that point in time and how long you've got left, etc. So the big problem with fixing is if the variable rates and the fixed rates drop dramatically. And I was personally liable for this. I mean, I thought a good fixed rate for 5 years was 3% or 2.8% or something. I locked in January, and then COVID happened, and all the fixed rates dropped, right? And so. The break costs went up through the roof, especially people who locked in around 4%, around when 2016, Trump time, when then fixed rates have dropped dramatically to say 2s and 3%. The break costs were enormous. So you have to wonder whether you're fixing now, whether the fixed rates are going to drop dramatically, and so your break costs aren't potentially that high. So even if you do change your plan. And you do fix and you want to go back to variable, you want to sell your property, maybe you don't have to be too concerned about your high break cost.
Absolutely, and the old break costs can be a bit shocking for some people when they actually realise what the numbers are. They didn't think it was going to work like that, so it's worth reading the small print if you do go fixed.
Yeah, and they have dropped recently, so because the longer term funding's dropped and the fixed rates are moving up, etc. like that. So if someone has done a break cost analysis 3 or 4 months ago because they're like, God, I'm getting smashed with this 4% rate, and they go and do the break cost analysis now, we're finding that it's a much more favourable to potentially break and pay that cost and potentially get in before rates rising again. So, if you have done it, I'd just urge you sort of go and do the numbers again because you might be pleasantly surprised.
Absolutely. Shop around, and there are some very good rates still there. And as you say, the break costs, that formula has definitely moved quite recently.
Yeah.
Now, Beige Shirt asked an interesting question about negative rates. Negative rates won't affect deposits. And it's an interesting observation because, of course, in Europe, where there are negative rates, the way it works is that people are being charged. They're being charged to hold money at the bank, but it's not a rate-based charge. It's just a fee, sort of so much a month to hold money in the bank. So, in fact, they haven't gone negative on the deposit rates. So whether that's going to work the same way if we were to go here. And the other thing is it's only on big deposits. It's not on small standard deposits. So it's 100,000 euros and above or something. It's true in Germany. It's true in some of the Scandinavian countries. So so far the retail end of deposits, even where negative rates are at the interbank level, haven't translated through to negative rates on deposits for most people. I
mean, if we go to sort of lower rates than where we are now, which I didn't think we would, but That means one thing: more people looking to take on debt, more people looking to invest who've got money in cash, and so you know what's going to happen to asset prices.
Absolutely. Now here's one from Mark. Do you think the government will do another stimulus if house prices start to drop?
They'll always try to stimulate the housing market, even when the market's rising. First home buyer grants have been going on for a long time, and that's all new debt. And that's the thing. If someone like upgrades, they sell their house, and yes, they add a little bit of debt, but there's always a point where they go, oh, I don't really want to go back into a big mortgage again. But first home buyers, that's all new debt, plus it's their savings, and then it goes into the property market, same as investors. So hence why they've got negative gearing. If you create another $1 million mortgage onto their portfolio, then that adds $1 million into the property market. And so absolutely, the government will always stimulate the housing market because a lot of those reasons, the wealth effect, the amount of money they make on property through tax, it's new property. If you add up how much money of that new apartment or that new townhouse they make in development costs and tax and GST and etc., zoning, it's a lot of money. It might be 30-40% of that $1 million apartment they make in tax. And so that's why they offer a lot of incentives to buy new. And you think, well, I'm getting this $25,000 free money. Well, you're not. The government, you're buying a poor asset, so there's a huge opportunity cost, which is a lot more than 25 grand. And the government isn't doing it because they're trying to be nice to you. They're doing it because the amount of money they make through that employment and all sorts of things. It's the multiplier effect is huge.
And of course, the other point there is that if rates were to start to go, or if prices were to start to fall, that would put pressure on the banks in terms of their security. And that would actually lift the capital ratios and things for the banks. So another reason why they don't want to see prices slide down, because that has a significant impact on financial stability. And I do think a lot of the decisions that they're taking, as well as those, economic GDP calculations that you've just mentioned, Chris, relate specifically to financial stability and keeping the debt ship roughly upright. Might be a bit stormy, but we'll try and keep it so it doesn't fall over.
Yeah, exactly. I mean, ultimately, they're just trying to keep the house, sort of the cards, running really.
Yep.
And so, yeah.
Exactly right. Now, here's another little one from Master Singleton. How would negative interest rates affect flexible rate home loans in the long term? And that's a very interesting question, right? Because the first thing to understand, and thanks for the super chat, by the way, the first point to make here is that the first place you'll see negative rates is actually interbanks. So in other words, between the bank and the Reserve Bank. So what it basically means is if the bank's holding assets they're not lending out, they'll actually be charged a penalty. And that will make them lend more, and it might even make them lend at a lower rate to just get the money out the door. That's what happened in Europe first. In the long term, though, the evidence from Europe is that banks then pull back from lending and do less lending, and they move into higher risk trading environments to try and actually make a return. So they actually reduce their lending because they can't take deposit rates down much lower. So it actually puts pressure, and it means they actually then start charging more on the loans that they offer because they ration the loans. So long term, negative rates can actually have an impact which forces variable rates higher. And I suspect that's how it would play out in practice.
Yeah, and like I kind of said before, it'll encourage behaviour that we don't probably need more behaviour of, which is taking on debt to buy investments, whether it's property or shares, etc.
No. Well, I think we're good enough at doing that without more incentives, right?
Exactly.
Now, one of the things I wanted to talk to you as we sort of come towards the last sort of quarter of the show is the concept of speed of market. So one of the things that we've touched on but not directly spoken about is that people are actually sometimes moving into decisions quicker than perhaps they should. And one of the things that I'm seeing is that people are cutting corners on the due diligence they're doing, relying, for example, on survey information provided by the vendor, perhaps not even doing all of the due diligence you normally expect. And it's the old adage, isn't it? You can repent at your leisure on this stuff when you go down that route.
Yeah, it's absolutely happening. So the pain of missing out, or the market moving on you, does two things. It gets you when you're in that emotional state. You've got a time frame, maybe a baby's on the way, etc. You start to get desperate and you just want to solve your pain, and so you start potentially compromising. So you compromise on location, you compromise on the type of property within that location. So you start looking at the busier roads, and you start to just say, well, let's just get something. We just don't want to miss out. If we wait, we're going to miss out. And so all that FOMO kicks in. So not only are they buying the poorer properties and paying big prices for them, it's absolutely happening, but they're also buying them without any due diligence. They're not doing the contract check. They're not getting their building and pest done because they haven't got time, or they've done it 3 or 4 times. I'm like, how bad could it be? Or they're not even checking the renovation, whether it was actually council approval, or there's lots of things like that. Or just doing like infrastructure checks. I've got a client trying to buy something in the beaches, and I was like, do you know about the tunnel? And they're like, no, I don't know about the tunnel. I'm like, well, it's pretty public knowledge, but it has a huge impact on that area where you're looking. And maybe it doesn't have a huge impact long term, but short term, there's going to be a lot of building that's going to happen, and you've got to be aware of that whether you want to live around that construction site for 10 years. So, local DAs, what's the neighbours doing? What are the people behind you? What's changing? Like when you're running at a fast, frantic pace, you just say, she'll be right, mate. Let's just get it done. And unfortunately, once you move into that property, you start to see the issues that you didn't see when you were looking at it. The noise, flight paths are a funny one. A client at the moment is trying to sell a place that's pretty close to a flight path, and they're going to relocate back to Melbourne. And that's an interesting thing as well. Where Sydney prices run, some of the Sydney buyers are going back to other areas, say Brisbane or Melbourne. And so I think you're going to see that interstate migration pick up. But flight paths at the moment, there's not as many planes, and those plane numbers are going to increase. So I think that's a funny one at the moment, where you think, oh, it's a beautiful backyard, but maybe 2 years' time when the planes are back, you've got a lot of noise. So yeah, due diligence is a massive thing. You can't, if there's something flawed about the property, you're better off finding it out prior to buying the property. And it's hard when you're in love with the property, but that pain won't go away, because if you either deal with it today, or you deal with it when you sell it one day. And all your buyers look at it and go, well, I'm not buying that because it's dark, it's south facing, it's got, building issues, it's got an ugly privacy issue. So you can't just go in, ears pinned back and hope for the best, because you have to wait for another boom-like condition to sell. And it's not always a choice when you sell a property. It could be divorce, it could be you need to health, it could be financial, it could be because you're really just at that life stage. And so then if you buy a poor asset, you're at the mercy of what the market is when you want to sell. And if it's a poor property, it's compromised, you may get severely discounted. And if you're not paying a discounted price when you buy, your potential returns are dramatically lower. So it's a real problem at the moment. Boom markets also encourage more poor property. We spoke about the investors before. We spoke about people who, want to do an upgrade. If you're in a great property, you're that incentivized to do an upgrade? Well, no, I will if there's something better on the market. But if you've got something that is not great, if you can get a better price than you could have got, you take advantage of that so you can get ahead of the market. And so poorer properties usually come first, and then the better properties come later in the boom. So hence why, we've got these problems.
Absolutely. I'll just give you one quick war story. I was talking to somebody the other week who ended up buying a property in a quiet street, but it was actually sort of round the corner from a strip, right, of shops. And he couldn't understand why it was that the vendor of the place that they were looking at buying would only let them come around on a Sunday.
Yeah. Lots of the smells, I guess, or something like that from the shops or something?
Well, it was actually a dry cleaners that operated 6 days a week, right? And they had one of these, big machines in the back garden with the humming all the time between 9 and 5, and all the vapour from the chimney would sort of come back over the fence, right? They luckily, I actually suggested they should go and have a look anyway. And so I always say to people, make sure you don't go the the same time every time you visit the property, right? Because you've got to actually go out of hours. You've got to go, particularly when there might be high traffic or when there might be high footfall or high activity, because those are the things that can really impact the value of the property.
Yeah, you might not be able to get into the property, and this is a frustrating thing for buyers. They might want a private inspection, but if you're a real estate agent, you've got 40 people on the property, you do a joint, and you do it at a time that suits that property. You know, when the sun's going through the windows and the garden looks the best, etc., and it's the quietest in the street. You know, you carefully select that. You get there early for the agent, and you turn on all the lights, and so that hides all your. Put some music on if there's noise problems, you spray if there's any mold issues, etc. So you're always going to see the property ideally in its best light from the agent. And so, you know, you really want to demand to see it at different times. When the market's hot, the real estate agent will just blank you and just say, well, look, it is what it is. This is when you can see it. Yes. So, but you can still go to the area. You can still stand out the front of the property, be a stalker and, you know, walk around, look at other properties and, you know, go at night. You know, mozzies can be a problem. There's so many things that you can figure out if you just do the hard yards and do the commute. You know, but a lot of people don't want to do that. It's just a lot of work. They don't think the property decision matters that much to their future. And, you know, they just want to just get it done. They just see it like buying a shirt or something like that, or sometimes less. But ultimately, it's one of the biggest financial decisions because, you know, you only make that decision once and then you sell it in 10 years' time. You don't sort of trade property. And so you'll only figure out whether that was a great decision when you sell it one day. So do that hard yards up front, and then you get the rewards for 10 years, you know, and you get that whatever it is in the end. So yeah, don't be lazy with buying property. Best off finding out and keep looking before you sign that contract.
Yeah, and I'll just add a few things there. One is check the flood plan. Right, you can actually find out whether there's flooding in the area. Check the fire zoning, particularly in semi-rural and rural areas. That tells you a lot as well. And the other thing, you know, which is really important, I think, is to think about traffic, particularly during rush hours. If you're on sort of, you know. Are you in a quiet street, but actually every rush hour it's a cut through road? Those sorts of things can make a huge difference, and quite often you don't find that out until you've actually moved in, which is too late.
Rat run's a massive one, Martin. I mean, you're so right. I think it doesn't. You know, you've always got the main roads, and everyone looks at those. But every suburb's got rat runs, and every suburb's got shortcuts, and they can be just as busy as the busy road. And they're usually a lot smaller, and so they can be a bit congested, and cars are stopping, and you know, it's hard to get your car in and out. And so the rat runs, which are hard sometimes to find out, you know, is a very big impact on property prices because everyone in the area doesn't want to live on that road. You know, and everyone said the main roads will always turn over more, right? They're generally not great places to live, and so everyone will be, you know, buying and selling in those. But there's also some streets that you'll find that they're selling a lot more. And the good chance is they're a rat run. And you don't want to be owning stuff on that. It's where the locals are always trying to get out of.
Absolutely right. Heard a few of the raw stories on that recently as well. Yeah. Now, as we sort of come towards the end of the show, one last thing I wanted to touch on is we sort of mentioned that apartments were doing really badly, and particularly the old high-rise, the, you know, carbon cut out, pile them high, all the same, all the way up, you know, 6 for sale at the same time, no differentiation. But there is another side to the apartment market as well. You know, the more family style, aspirational apartment, the bigger, maybe the older one, which looks to me as though that's a bit on the turn.
Yeah, absolutely. A lot of people who are from Australia, they live here now, they're Australian citizens, but maybe they weren't born here and they've moved here and they've potentially moved lots of different cultures, Europe, you know, Asia, etc. And, you know, for them, living in an apartment is completely fine. You know, they've lived in that before, they've grown up in them, and they didn't move to Sydney or Melbourne to live in the middle and outer rings. And so for them, they want to be in the action as well. They don't mind, you know, they want the community. They don't need the sort of backyard. And so they've always been massive lovers of, you know, just buying a nice apartment and living in a nice suburb. And so, and that's a huge part of the capital city markets anyway. The problem is when you've got a lot of the people who prefer the house and they're then going to the apartment market, plus you've got investors, that's when you get these real sort of competition under these sort of apartments. And a lot of the sort of people who want the house have gone to get the house, whether they've gone to Central Coast or Wollongong or Inner West, or as those prices of those properties rise and they get less options there, now they're going back to the apartments and they're saying, look, we don't want to leave the city. We want all the lifestyle benefits. We're just looking for a really nice apartment. And so we're getting lots of clients back buying apartments that would have potentially bought houses last year, but they've run on them. And we're also seeing the investors come out. They're going, we just can't compete with first-time buyers and upgraders. We're not that desperate to pay these big prices for houses and the maintenance. Why don't we go and buy a really nice older apartment? And so investors are back buying them. The downsizers always love them. First-time buyers, people not from... and migration, when migration does kick off again, and it will, Australia is more desirable now than it was a couple of years ago compared to global standards, especially if our economy does and unemployment sort of drops as well. The government's ticket to the game, we spoke about property, but the other ticket is migration and bringing in overseas talent, financial capital, and bringing it back into the Australian economy. And so when that happens, I think you'll also find the good sort of older apartments will do well as well.
And the point to make there also is that the older apartments are better built. They've got more structural support rather than just the very thin materials that are used on the modern ones, and they're less likely to have the flammable cladding issues as well. So it really is quite significant.
Yeah, I think speaking to building inspectors, they're not, older apartments are not without their issues, concrete cancer, rust, fire upgrade. There is lots of problems potentially with older apartments, and so you can't go in blind buying them, but you do want to buy one of those really maintained buildings, great strata reports, something that looks loved. If it's not loved and it's an older, you potentially are taking a big bet. So how it presents and the strata, it makes a huge difference on whether you should consider it.
Yeah, absolutely. And I just want to acknowledge the number of people who are liking the show. A few people said, hey, not many people are liking the show. Please do like this show. It really does make a difference in terms of the way that YouTube actually propagates the show. And we get a lot of post-show views because of the likes. So, I'd love to see the likes go up over 100 before we finish. So, folks, if you haven't liked it, please do so. It's definitely worth a like. The advice you're getting from Chris is, really, really powerful, and no doubt in my mind that people will learn a lot from just listening and enjoying the show and joining in the show. So please would appreciate it. Okay, so we're sort of here. We are, April time. We come through winter. I guess the thought maybe we're going to see a bit more property price listing. The virus is going to take longer to get under control. The borders probably won't open until next year now. We might not even get the vaccines finished until next year. So what's your read, Chris? Price is still going to go on up or what?
Yeah, so the border issue is, if anything, that just brings in more demand. It's not needed to support property prices. And if anything, if we can't go out of the country, we're saving and we're renovating our houses and we're focusing on our house. So I don't think the migration issue was ever really a problem. It is in areas where you've got high-rise apartments where lots of migration go. It is for university places, etc. And so that's got a big impact on the market. I think ultimately the demand is massive. We've got more pre-approvals than we ever have. Not just on a client number, but also a volume number. And we had actually a really quiet month in March, just how many people were missing out and getting blown out at auctions. Shows how many desperate buyers and how many people are bidding on properties. And so more listings will come. Will there be a winter sort of break? I think everyone thinks, the real estate agents who love to sort of go to their Mykonos sort of holiday in winter and summer, they can't do that. Do they keep working? But I think they're going to have a break, like every year. Everyone's got to have a break at some point. So I think you will still see these listings drop off as we usually do. And at that time, a lot of people will be, looking to get into the market. So I don't like to be so bullish on the market, Martin, but when we look at the numbers in terms of people's appetite to take on debt, amount of buyers out there, pent up demand over the years, you will start to see these quality assets still getting competed on in 6 months' time.
Absolutely. And, my own modelling is suggesting that in a number of areas we are going to see continued growth. Not universally, though. I'm also seeing some areas where the story is quite different, and those inner suburban areas, particularly some of the property that's probably on less good streets and stuff, definitely struggling. And I'll be doing a few shows over the next few weeks based on some of my recent one-to-one conversations, where I'll just paint a few pictures of what I'm seeing, because even over in Perth, for example, I'm seeing areas where there's very little growth in the value of properties, despite the high-level headlines that Perth prices are booming. And by the way, in Perth, prices are still well below where they were back in 2013. Just to remind people, the prices don't always go up, right?
Yeah.
And sometimes that cycle of peak to next peak, that's nearly 10 years. So it just is worth reflecting on that.
Yeah, what I was referring to there is sort of the Sydney housing market in good suburbs, good streets. I mean, that's just really what our clients buy. We don't buy any house and land packages, off-the-plan apartments, new townhouses, etc. Things that have got the supply problem, I just don't think there's, who knows what's going to happen with those prices. You've got more supply coming, demand. If there's more demand, there's more supply. And so that's Sydney. But you're right, like places like Perth, what's going to rise in Perth? Well, I can guarantee you it's every of those little houses that are anything from the city to the beach, a little bit further north, a little bit further south, and in all the areas where we've got good schools and good places to live for aspirational sort of younger families, will be going through the roof. Once you go to the other side where all the house and land packages are, the apartments will still be struggling. So there's always a multiple tiers to every market. Brisbane, for example, it's absolutely going nuts in the inner ring. Things around the river, things in that sort of 700 to low to mid ones price point. But, if you're spending less than that, some of the properties, Logan, Ipswich, prices aren't going nuts, right? So, a lot of people can read the headline and, know that it's nowhere near like that on the ground. There's certain pockets that are doing much better than others.
Absolutely. Well, you have to go granular, as we keep saying, and, you really have to look at comparables and all of those things. And unfortunately, quite often, the high-level headline, which is then replayed in the media and on TV and all of those sorts of things. And I will just make a couple of quick points here. SQM published their latest auction results, right? 67% in Sydney and 59% in Melbourne, which is just showing you that there is an alternative story with regard to auction clearance rates. Don't necessarily believe the things that the media throw at you. I think the SQM rates is quite a lot closer. And also the SQM data on vacancy rates is quite interesting. The vacancy rates are rising. And I'm seeing that in some of my data. We're seeing quite a lot of spare capacity, particularly around rentals. And so a lot of people with rentals are hanging on to their existing tenant, hoping that they're not going to go away. But we're also seeing another move, and that is a lot of people are now forcing tenants out with a view to selling the property. So that's something, I don't know whether you're seeing it, Chris, but I'm seeing it in some of my surveys.
Yeah, so vacancies, if you're renting a property and then you become a buyer, you go out of the rental pool. If you're an investor and you sell your house or an apartment and you sell it to an owner or occupier, that's another property outside the pool. A lot of properties need that migration. That's what's, driving a lot of their options, that couple 100,000 a year in their city. And so vacancy rates won't be across the whole city, but if Sydney's vacancy rates are rising, I guarantee it's probably things around university as in apartments. Those areas are still struggling. More and more apartments are hitting the market in those areas. But if you go into the housing market, if, for example, like a lot of people go, can I rent this house? Or so let's say it's a really good suburb and there's 90% of the houses in that suburb will be owned by owner-occupiers. 10% of those properties might be owned by investors, right? And those investors would have bought those houses, say, 10 or 20 years ago. Now, when that investor sells that house that's currently in the rental market, it's now unaffordable for other investors. Other investors say, I'm not going to buy a house for $2 million as an investment. It's just the subset of investors that can afford that is quite small. And so in these areas, that number of houses for rent in that suburb have now dropped to 9. And then as the house prices rise even further, now the houses for rent in that suburb drops to 8. Because as soon as someone sells those properties, they sell it to another owner occupier. So renting actually becomes harder every year to rent houses and things in good suburbs because there's not more rental demand, rental properties available. There might be apartments, there might be townhouses, but not the houses because there's just limited stock.
Yep. Very good. And interesting suggestion there about local government. Yes, there's an interesting conversation to be had there. We might get to it at some point. Somebody asked about SMEs. I'll just put that one up. Zach said, SMEs travelling now, JobKeeper is over. Not well, according to my surveys. So I'm still seeing a large number of SMEs who are still saying that they're probably unlikely to survive. And by the way, every little lockdown and every slow recovery with regards to particularly the migrants and particularly the international visitors is really still hitting a lot of areas. I was doing some work the other day looking at Cairns and around there. It's not pretty. So we'll probably do a show on SMEs sometime down the track. Well, we're pretty close to the end of the show, Chris. Any last thoughts, anything we haven't covered that you think we should have covered?
I just think people really need to understand there's a repricing of property that's happening because people are willing to take on more debt at lower rates. And so, a property is how expensive a property is how much the mortgage is going to be. And if the mortgage is much cheaper, then the property is much cheaper. Chris Joy, did write an article on this last week and around the housing potentially, more affordable than it's ever been. And, and Chris Joy has called pretty much every up and down in this market. And so I think he's a good voice to sort of listen to. Interest rates will drive behaviour and they are driving behaviour. So unless something dramatically changes to interest rates and they jump, you'll find that a lot of people are willing to take on more debt, especially when there's this positive feedback loop. Prices are rising. We've got to buy now. Investors start coming in. So, we're in that environment right now.
To which I would say, yeah, except we've still got lots of stress out there. Mortgage stress is a lot higher than it was, before COVID hit. And
we saw people come back on repayment holidays. Everyone, there was a big thing talked up about that for a long time,
Yep.
Who aren't going to pay their mortgages. Look at the percentage now, it's under 0.5%, even if that adds onto the arrears rate, it's not a big deal. Yes, there's potentially, mortgage stress, but as long as rates stay low, that mortgage stress is manageable for a lot of people. And because, their repayments are low. So the JobKeeper and businesses, if you've got a business in the CBD or you're reliant on tourism, which is a lot of the CBD anyway, or people coming back to offices, those businesses are going to be dramatically affected for some time. Or if you've got a business in Cairns, but a lot of businesses aren't reliant on that foot traffic, and we've got so much diversity, to our economy, I guess.
Absolutely, and like I always say, do the local work. Don't take the high-level stories because you've got to get local. If you do that, you're going to do a lot better than just swallowing the high-level story. And my view is there is definitely momentum on the upside. There's also some issues on the downside. Depends where you look, and it's going to be a very interesting journey ahead. Chris, I really appreciate your time tonight, and I know the audience have too. They've been appreciative as you've gone through with your thoughts and suggestions and comments. So thank you very much once again for spending some of your evening with us. And I look forward to the next conversation because based on what happened since the last one, the next one's going to be a really interesting one.
I think it is, Martin. I said at the start, I think, yes, prices have been massive in March and February. I want to see April, May, June, July, and also what happens after winter. So, you've just got to be careful at the moment. Whenever markets are rising, they'll generally rise farther and further than you expect. I was thinking that in the 2015-16 boom, surely prices have got to slow down, but then they still went for another year, right? And so, you kind of got to be careful. You don't want to be the one who's bought in 2017 at the top of the market and you really crystallize not making a lot of money because you bought at the top. So you've got to be always careful as you're buying into the market and you aren't the one carrying the can at the end.
Absolutely. And as with all of these things, it'll change again. These always will change. But the length of time it takes for some of those changes to propagate through is often, I think, underestimated. So, you see things over here, but it doesn't propagate immediately. So there's always some latency in the whole system.
Yeah.
Well, Chris, thank you very much for your time tonight. Really appreciate it. And I'm just going to close the rest of the show now. So thank you very much. And we'll catch up again soon. Cheers.
Thanks, Martin. Good to chat as always. Thanks, mate.
Bye-bye. Okay, so just to tidy off the show tonight, I just want to give you a bit of a heads up for next week. This is going to be a really interesting show next week. I have got Senator Gerard Rennick coming on. He's a Liberal senator from Queensland, and we're going to talk in detail about Reserve Bank, central banks, monetary policy, all of those things, and his views relating to some of the policy changes that need to be done. He, of course, was the guy who threw some balls at the RBA recently in one of the recent estimates. And so Gerard's coming on for an hour and a half. You'll be able to ask him questions direct. And so mark your diary. And I think this will probably be one of the most interesting shows of the year. Not to say that Chris's wasn't, but I think it's going to be great fun. So mark your diaries, and that'll be same time next week, Senator Gerard Rennick. And with that, just one other thing, those of you on the Patreon tier to get the stress data, you should be receiving in the next day or two an email relating to access to the members portal and to be invited into the beta test that we're running at the moment. I'll tell you more about that on another show, and specifically discuss the members area, what we're doing, and what we're hoping to build into it later. So watch for those emails. It'll come from members at Digital Finance Analytics. And with that, I want to say thanks very much to everybody for spending some time with us tonight. Really enjoyed the conversation. Very, very interesting chat with Chris tonight, and more to come ahead. Thank you very much indeed for spending this time with us, and I look forward to seeing you next week. This is Martin North from Digital Finance Analytics, signing off.